Welcome to Beyond Rent, the property management podcast brought to you by Rent Manager. Each episode, we sit down with an expert to talk industry updates, tech solutions, and top tips for those in the property management space. And now, let's get to the conversation and go Beyond Rent.
Hey everyone, and welcome to Beyond Rent. In today's episode, we'll dive into the role rent reporting has in our industry. We'll look at how credit reporting drives resident behavior while building their credit history. And to help us learn more, we have Tony from CredHub joining us today. Tony, welcome to Beyond Rent.
Thanks, Joe. Appreciate it. It's great to be here this beautiful morning in Ohio. It was a good drive to get down here, but love it.
Yeah, thanks for making that drive. You're just right up the road in Columbus, so a few hour trip down to see us today. So we really appreciate you stopping in the office. And as we get started here, let's get to know you a little bit better. Go ahead and introduce yourself. Tell us what you do at CredHub.
Yeah, so I'm Tony. I'm the President and COO at CredHub. CredHub, we report residential tenants to the credit bureaus on behalf of the property management companies. I kind of came into this role in the past year or so. Before that, I was Chief Technology Officer, hired in as Chief Technology Officer here, built out a ton of technology, including data integrations with Rent Manager, which we love Rent Manager's API and the ease of use and the supportability from that. Prior to that, I kind of came up as a developer, and so I've been in technology my entire career. I was a developer. We built things for handheld technologies back in the early 2000s, which was really wild and it was a lot of fun, and did a lot of things with logistics and Department of Defense, and then kind of moved on later through consulting. I ended up at a commercial real estate. I eventually worked for them full time. I was consulting, and then full time we owned shopping centers and malls based in Columbus, Ohio, and kind of ran a lot of their everything that was app dev based, ran that for them. We went through a major merger and acquisition where we grew by about 4.5x. So it was a huge opportunity, a lot of fun to go through that. Learned a lot from the commercial real estate side, really kind of sparked my interest in real estate after being in other verticals, a lot of fun. And then went to work for a prop tech in Columbus. It was a startup. We provided renters insurance and a few other smaller products too. Built that up, and that was a lot of fun. Got more onto the residential side, which was even more interesting. And then that kind of led me to CredHub and this product that I love. I think it's a great product. I have a big passion for credit. It's something that I learned really early on, the impacts of that and what it means for you as a person. And so it's good to kind of mesh together this passion I've had all my life, basically, with technology, with a great company.
Yeah, that's great. Thanks for that insight. And it is really interesting that you have some of that commercial background, and now you have a lot more of that residential background over the past few years. It's really no different than some of what we do, right? We're kind of very heavily involved in the residential side. We do some of the commercial side. But either way, a lot of real estate is very similar, or there's connections that you can make along the way, which is always exciting. And it's always fun to hear people's journey of what they did many, many years ago to what they're doing now, and how they kind of bridge and continue to grow. So it's been fun to see you do that, growing your career, growing your influence, and continue to build up, especially the product, I would say, here at CredHub, right? So that's definitely what we want to learn a lot more about today. And you talked about maybe having some experience yourself with knowing the value of having good credit. Tell me a little bit more about that, if you could. Like, where did that education come from? How did you know that having good credit was important?
Goes back to being a child and, kind of watching some of my parents and their activities and such, and kind of learning from them, learning the importance of what good credit and how that impacts you overall. Then, kind of ironically, while I was in college, I worked for a servicer for credit cards, and they did everything from the application process through the collections and everything else. And I was actually in the collections department. And so I kind of watched how this directly impacted, negatively impacted people, and where that can really harm you, which means that the other side of it, of building your credit up, is something that will help you overall. You get access to better products that have cheaper rates. Typically, it impacts everything, including your insurance rates. All kinds of things are measured with risk. For a good while, the Department of Defense would actually look at your credit score and make a decision about hiring you based upon your credit worthiness, because they could see you as a risk overall to what their mission was. That's all very niche type of things, but those are things that I saw over time, and so it's always been with me. And my personal credit score has always been incredibly important to me, and watching that, making sure that I was always ahead of everything, making sure I wasn't behind, and getting to see the positive side of that. So that was really where I learned how what this impact means to you.
Yeah, and I'm glad you shared that, because I think there is just this reality that if you don't have experience with some level of credit and working in collections, I'm sure was an eye opener, but also that early education in your childhood, kind of hearing people talk about things like this. And I can relate. I know there are people in my life that have always spoken about, the credit's important and my credit score is important, and this is what it allowed me to do. And hearing those conversations is really impactful, but not everyone has that experience, right? Mm-hmm. So not everyone knows the value of it until it's almost too late sometimes. And not that you can't rebuild credit, because you can, but I think we all know that if you're given the tools early enough and at the right times, a lot of it can be done without you even knowing it's happening, right? And you can start building up that credit and getting yourself into a good place.
Yeah, I mean, it's just like saving for retirement when you're young and you seem like you're kind of trying to build an elephant up from nothing. And over time, that compounding interest does make up for it. But when you're early on, you don't realize the long-term effects this can have. And certainly, when you look at a young person maybe that's in college that doesn't have access to a lot of credit, maybe they got a credit card because they were in a retail store and was offered a 15 or 20% discount to sign up, and then they didn't pay it. And these are the things that I witnessed in these people's credit scores as kids, and they're getting ready to go into the workforce and probably in a few years maybe try to get at least an auto loan or a mortgage, and it's going to be really challenging for them. And this is great that in about 2017 or so, FICO and Vantage changed their scoring model, which we'll talk about later, changed their scoring model to include rental reporting. And so as a young person, if you are renting a house or apartment or anything like that, and you're having this reported to the credit bureaus, it can really positively impact your credit profile over time.
Yeah, that's great. And obviously that's definitely what we want to discuss today, is how this all works in the rental industry and the importance of it. And one of the things that I hear a lot about, and I want to get your take on it, is how somebody's rent being reported can actually alter how they act, right? The way they behave. It reminds me a little bit about some of what you're talking about. If some of these people that got those department store credit cards would have known how high the interest rate was, would have known the impact on their credit score when they signed up, would they have made different decisions? And I think that's part of what I think about when it comes to paying rent, is does it really drive people's behavior?
Yeah, I mean, it certainly has. We've watched people do all kinds of different things, both from a positive and a negative side. So the credit bureaus and the Fair Credit Reporting Act says you need to be complete and accurate. And, there's probably a question about, do you report negative or not? And that's a whole other topic we can talk about. But just on the whole, when you are paying 30 to 40% of your income every month, that's something you should be rewarded for that. When that gets reported to the credit bureaus in a positive way, most people do pay their rent on time. That trade line is huge. It's a lot of money that you're showing on your credit report that's continuing to build up your credit over time. It's huge.
Yeah, it really is important. And you just mentioned that 30 to 40%. We all know rent is expensive. Mortgages are expensive. Anything is expensive these days. But historically, rent was not really included in rent reporting. There wasn't always the mechanisms in place and the value put on that. So people that rented for years on end and then went to buy a home or something like that realized at that point that maybe their credit score wasn't where it was supposed to be, and they had not been given credit for all of these payments they'd made on time over many, many years, or even just a few years. That can make a big impact.
Certainly, and when you kind of asked about the behavior shifting that this can be impacted by, is on the positive side, people know they're being rewarded, and then they can see their credit score going up really rapidly. We did some cohort analysis for about 6 months, and we watched people that had thin credit, which means almost nothing, no credit, and really poor credit, and have some really good successes with that. We saw somebody go from a 480 credit score to a 620 in about 6 months. And that's incredible. That goes from basically not being able to get any products to being able to get products, and maybe at some favorable rates. Those are not really, typical situations. When you kind of average it out, I think, it's about 40 to 60 points is where you kind of see those credit score increases. But people do know that this will impact you positively. So we have some of our customers, and our direct customers are the property management companies, just like you. And we have had a few tell us that, gosh, we struggled with delinquencies for a while, and now we actually have people paying early because they want to make sure that that rent is paid on time, everything is all buttoned up and good to go. So that behavior shift was huge for them. On the what we call the negative side, so reporting, negative balances, both for folks that are active leases, people living there, and then maybe those that have moved out too. It helps to correct the behavior because you have another kind of mechanism to help influence that renter to pay you, because you're showing, gosh, this is getting reported negatively to your credit bureau.
Yeah, and both sides are important, right? And I think especially on the positive side, there is a lot of awareness on credit scores now, maybe even what I think years ago looked like. When I think back to, my 20s and stuff like that, there were some people talking about credit scores, but there wasn't the awareness that there is today when you think of all the different credit programs that are out there, ones that are on TV all the time, advertising. Just in general, there's better public knowledge about the credit scores and how they can be impacted. So I think just that general awareness is out there. So people want to have a positive impact there. But that's really interesting that people start paying early because they are concerned about their credit score. They want to protect it.
Yeah, absolutely. Yep. It's definitely a behavioral change and mechanism to help influence that, how they're paying their rent.
So talk to me more about how the resident actually interacts with this, with most rent reporting. What I mean by that is, are they fully aware of what's happening when the rent's getting reported? Are they seeing updates on a regular basis? Is that transparency there to help further encourage that? Or do you tend to see most property managers are just alerting them early, like, hey, we report your rent? Or is there something ongoing that's happening?
That's a great question. I think early on, this was a very passive situation, and so people didn't see the value of it until they needed to access their credit for some reason. So they're getting an auto loan. What we've learned is that this passive thing that's happening in the background that, maybe folks are getting charged for, maybe they're not, they don't see the value of it till much later. So it takes a lot of communication upfront during the leasing process to, convey the importance of it, what it means. And then we do continual marketing and information both through the property manager and directly to continue to inform the resident of the benefits and of this feature that they have. And it's such a small thing that happens in the background that has such a huge impact later. We also have tools where they can then see their credit score, and they can see it updated monthly. They can see it on their credit report too, so they can see the rest of their credit report, maybe other things that are influencing it to tell them there are some things that, maybe they can improve on to even amplify their credit a bit more. So certainly the communication and the transparency to the resident helps to bolster the importance of it. I think there's also more of a grassroots movement that's happening. We're having a lot of property managers come to us saying, hey, my residents are asking about this. And these aren't even legislative reasons, in California that we'll talk about later, but these are just people being aware that this is a product that can be offered, and I want it, and how come you don't do it for me yet? Yeah.
And I think the transparency piece works on both sides, where people can see their credit score growing over time, but also those that may be not paying on time and having negative reporting happening, at least they're aware of it, right? Which I think is really important, that if they get down the road and they try to apply for an auto loan or something like that and find out they have less than desirable credit score, and they go look and they find out it's because their late payments were being reported, at least if they're being told along the way, they have an opportunity to change that behavior and get ahead of it rather than, again, waiting 3-5 years down the road. And that's already done at that point. Now they have to go back and repair.
Yeah, and repairing, there's no such thing as just kind of rebuilding this thing. A repair has to do with more of fictitious or, things that were reported incorrectly or anything. There's no really going back. The interesting thing now with, I think it's called FICO 10T, that T stands for trend, is instead of just taking snapshots in time, basically, it's showing a trend now of what things look like. And so your scoring model isn't based upon, we may have seen where somebody reports negative or gets, something dinged on their credit report, instantly their credit goes down. You'll see their score go from some number to significantly less because of that. Well, now with 10T, it's more of a trend of things. So it smooths out those situations so that, maybe if there are some hiccups along the way, you can show a better trend. And I think Fannie and Freddie have both said that that's a scoring model that they approve of using for mortgages. Now, getting the lenders there, in that scoring model, that might take some time, but certainly that's impactful.
Yeah, well, and that's interesting. I wasn't aware that was out there, and I think that's interesting from the standpoint of life does happen, right? And some people are in really unfortunate situations, and if historically they've done a good job, it's good to be able to see that, right? That obviously they're facing some challenges, but you can kind of see how they recover from it and see what direction they're heading with their credit score rather than just a moment in time.
Yep, exactly.
Yeah, that's great. And then I want to jump into the regulation side. You kind of hinted at that. There's always lots going on, right? With different legislation, different states, different geographies. Give us maybe the current state of things right now from what you're seeing as far as regulation requiring rent reporting, because that's not really historically what was in place.
Yeah. So, we start at the federal level with the Fair Credit Reporting Act, and there are things that it says in there, not so much about specific types of trade lines like rent reporting or anything like that, but talks about your obligations as a data furnisher and what you should be doing in terms of being accurate and complete. And so there's a lot of regulations around just how you do it, what you should be doing. You're responsible for it. You're responsible for fixing problems, things like that. When you look at the credit bureaus have some governance over this too. They are there collecting the data. They're kind of monitoring the furnishers, monitoring the aggregators like us that are pushing the data in and making sure all the data is accurate and that we're, not veering off course anywhere. The interesting thing that they say too is that they want both positive and negative data. They want the complete picture, which every trade line that we've ever seen, from credit cards to auto loans to mortgages, do report the good, bad, and the ugly, as you would say, right? So there's that side of it. Now what we're seeing, though, is in state and local governments. So we've seen several counties adopt a positive-only opt-in requirement. And then all of these are themed the same way. California did the same thing across the state, where you have to, as a property manager, offer rent reporting to your residents positive only. So not the complete, just positive only. You have to offer it. And then typically there's no way for the property manager to make any money off of that at all. So it's a pure at-cost situation. That's how all these laws have been written so far. And we're seeing that continue to kind of proliferate into other states. Nevada copy-pasted California's law and changed California to Nevada, quite literally. That did get shot down, but we see that happen. New York has something that's being worked on right now. Washington's tried it a couple of different ways. Colorado has something as well. And so we're seeing this kind of movement towards state, at least at the state level, requiring property managers to do this. So it's kind of better if you're a property manager to just get ahead of it and start doing it rather than waiting to be told to do it. It was actually interesting at your conference was that November? That's right. Yeah. In Palm Springs, last year. We were talking to some folks. We're like, hey, because ironically in California, that law was passed right then. And we said, were you aware of this law? They're like, yeah, but it's not till April. We're like, well, no, that's when you have to have it ready to go. And so many people didn't even know about it. So when April came around, we weren't blindsided, but the property managers were blindsided and by it. And we had this flood of people coming in kind of after the fact. And so better to kind of get ahead of it than wait for the regulation to come in and tell you.
Now, help me understand why these regulations are being written in a way that is positive only. Is it truly just renter-friendly regulations? Is that really kind of the main point, or are they trying to lower the bar as far as ease of reporting? Because I don't think it's any easier to report just positive, right?
Well, so when you report positive, typically the kind of feedback you get from residents that are unaware of it or kind of confused by it is, what is this thing? What is this? Why is it on my credit report? And then you're told, oh, okay, that's great. When you have the negative side, it's like, now you've got to deal with disputes. You've got to deal with other things. Bankruptcies are a big part of that. So there's a lot of things you have to do on the backside of it with the complete. So when negative gets reported, there's a lot more work for the negative the side than the positive. Your point about being renter friendly, laws are really there to protect the people generally. And so that's what they're trying to do, is protect the people and, impact their credit report. But then they shaved off the negative side of it too, where it's like, well, it's only the good stuff. So the positive side is incredibly helpful for the resident. And I think it's a way for legislation to ease their way into property managers requiring this rent reporting. The positive only side, it's good, but it's not the complete picture of it.
No, I'm glad you broke that down, because I do think that makes sense. If we were going to make a change, make a small one, right? So let's start here with positive only. Let's get people behind it, excited about this idea as we kind of move towards this idea of maybe unifying or standardizing the whole process in the first place.
Yeah, and it is kind of wild when you think about it too, because there aren't any real regulations that require a mortgage servicer to report, to require an auto lender to report. This is really the only trade line where you're kind of requiring it to report. And it's kind of interesting to watch this happen. I think it's great. The idea of reporting positively, I think this started a little bit with Fannie and Freddie. Their program started a few years ago where they subsidized this type of program with for several property managers. There's some kind of ways to get to that, but it was positive only, not negative side. And so they, helped that side of it too. And I think that this idea of, okay, if you're going to put a regulation on this, let's do it in a way that only benefits and can not necessarily negatively impact the consumer.
Yeah. And for people that are, I would say, looking into it and trying to learn more about the situation from a renter standpoint, I'd imagine there are some renters that are fully aware that most are not reporting rent, right? When they're looking at the big picture, they understand that this is something that doesn't get reported to the credit bureaus. But I'd say in general, most of the population probably is unaware that it is or is not happening, right? They probably just don't even know to even ask the question, because historically it's never been a thing, right? It's never been something that's been happening compared to auto and mortgage, where everyone understands that. That's always been part of the program. We're definitely seeing a shift now.
Yeah. We've been able to report residents to the credit bureaus for decades. That's something that's been completely allowed. It's kind of in the other bucket, and so it didn't really impact the scoring models in a real meaningful way until about 2017, when FICO changed, with FICO 9 and Vantage 3.0, and they started incorporating that as its own trade line. And so that means it can be weighted separately. And we know that the scoring models are mostly impacted by your payment history, meaning are you on time or are you negative? That's a huge, probably 35-40% of the scoring model that we know about is related to that activity. And so now this being in there, starting in 2017, people that rent tend to not have other large debt that they can really have positively impact their credit report. This is a great way to, bolster people's credit so they can be, get access to other products and maybe get a mortgage in the future at a really good rate, definitely get an auto loan at a good rate, insurance, all these other factors that rely on good credit.
Yeah. And when you think about building wealth and having access to more of your income, these are all things that really, really do matter. Well, let's talk about these scoring models. You've mentioned a few times. I have been, I guess, aware of credit scores for a long time, understand what they are, the credit bureaus, but I don't think I understand the credit scoring models. I've heard of FICO, but I don't really understand what that means. So help break that down. What does it mean to have a scoring model, and why do they exist?
Well, there's several different models and several different numeric kind of values that are assigned through those models. There's something called a beacon score. There's FICO. There's Vantage. I think the most well-known, Beacon is probably more about auto loans. People have maybe heard about that. It's used more in that way. FICO is what we've typically heard, and they're selling their scoring model, and that's why you hear it the most. And Vantage is actually interesting. It's all three major bureaus, Equifax, TransUnion, and Experian, saying, okay, this is what we think the model should be, and this is how the algorithm should be based upon the inputs from a consumer's credit report. And that's what the number will come out, so that it's more consistent. Because what you may have seen is that in certain other models, the numbers are wildly different. You might have from one credit bureau, that scoring model might be a 625, and that one might say 650, and that one might say 680. That's a huge difference. I mean, if you're trying to get a mortgage and your score is 620, the rates you're going to get are dramatically different than the ones you'll get at like a 680. Vantage, I think they tried to normalize that so they all look very similar. And so these are just different scoring models. Now, who uses these models? It kind of depends on the lender. Certain lenders use Vantage, certain lenders use FICO, Beacon, other ones like that. And the version that they use is dependent upon how well that lender feels through the underwriting process, how well they feel about the risk associated with it. So, each version of FICO, certain lenders are going to necessarily wait to adopt the next version of it until they understand truly what the risk profile is associated to that.
That's really interesting. So are lenders actually like testing out new scoring models with maybe subsets of their applicants to see how many get approved, how many end up defaulting, to see how it compares to their current? I don't know if you know that, but I think that's really interesting that all of these things exist. Because I think for a lot of people, they think a credit score is a credit score. Why would it be any different? My payment history, my credit history isn't any different. Why is my credit score different in different scenarios?
Yeah, these models that have been adopted over time all take into account different situations. So like I said, where FICO 9 did not take into account rental reporting, that means FICO 8 doesn't have rental reporting trade line taken into account. So if somebody's using a FICO 8 model, this rent reporting that has been great in building up your credit for all these other models hasn't impacted that. And so we want people to move, we want lenders to move up. And I think that kind of the behavioral influence that Freddie and Fannie are doing with, I told you about the FICO 10T model. And so, we've got 8, 9, 10, and then T stands for trending. And it's basically kind of leveling some things out. So it's not just this blip in time. And Fannie and Freddie say that, the FICO 10T is an acceptable model for them. They think it's a trustworthy model. Now lenders, it's up to you to decide. And so I think their underwriting, they have to kind of play with this over time and see what that risk is going to be. I don't know how they actually do it. I don't know if it's, okay, when a new model comes out, we put 2% of our risk that way, or what they do. I don't particularly know exactly how they use them, but or when they adopt the next version of it. But certainly, I think when you look at higher value items, the adoption of the newest version of that model is probably going to be slow.
Yeah, that makes total sense to me that you would have to test it out, make sure that it's producing the results that you expect, because these companies are using these credit scores to, like you said, manage their risk. So it's very, and that's no different than our industry, right?
Exactly.
When we look at running credit scores for applicants that are applying for a home, same idea, right? There's credit worthiness. There's a certain bar that every property has put in place to say, hey, this is where we think you need to be able to rent here. So it's really no different, right? So I think that's very interesting. So as far as like thinking about credit scores and credit models and things like that, that's all important. I think that's all kind of like in the weeds in the end result. The real point is we as an industry need to figure out more of how we engage with rent reporting and credit scores for our renters, because it is a big portion of their monthly income that for, I don't know, the vast majority of people, they're not getting any credit for this at this stage.
Yeah. So we've talked a lot about from the benefits of the consumer side and the renter and what that means. There's also a huge secondary piece to this, and that's the property manager. And the property manager is going to benefit from lots of different ways of implementing this. If they're using us, using somebody else, there's lots of different ways of doing it. We have a very customizable way of handling it. And with our integration into Rent Manager, it's incredibly seamless. The other thing that is this kind of side effect that's going to happen over time is the screening, or when you're trying to renew that lease, that's commercial side. Gosh. Renew that lease. If you could always look into Rent Manager and see, how did this person perform? But if you look at how did we report them to the credit bureaus and you're having that data, you can kind of use that same trending data to make a decision about gosh, maybe I should cut bait with this tenant and get a new one. It could be more beneficial, even though we know it typically is more costly to turn a tenant. It could be better overall because it's a hassle. I might have gotten some additional revenue and late fees, but the late fees are there as a deterrent because it also takes a lot more effort to continue to, come after those past due balances on whether it's the second day, 5th day, 10th day, 15th, 30th, whatever it might be, plus the eviction process. The other piece with that we haven't really talked about is when this data gets reported to the credit bureau, there's a layer of identity that's added to this. And so if you have no credit report, now all of a sudden you have a persona with the credit bureaus. And so when we talk about who are you and what is your identity, it's a way to add to that identity verification. So it helps you as a consumer. On the backside with a property manager, when we're doing tenant screening, now we can actually see Joe as a real person. We can see maybe some other credit pieces of his profile. But if we as an industry overall also look at this rental trade line and start using it and really focusing on that, because that is what matters to us as PMs. Now, if we are all collectively sending this data to the credit bureaus and we're getting it back and looking at it, we're kind of feeding our own knowledge base.
Yeah, that's such a bigger idea and a bigger view of what's really happening, because you could, like you said, you could easily focus in on the fact that it's really good for the consumer. You could even focus in on how it drives on-time payments, right? But to look at the industry as a whole, kind of zoom out and say, well, this is really good for the whole industry, because if we're all doing this, if we're all reporting rent, we all can benefit from this data ongoing into the future. Because one of the big trends I think we continue to see is people are choosing to rent as a lifestyle. Mm-hmm. Right. Historically, yes, you had people that were lifelong renters, and that was fine. But the vast majority of people were renting for a short time period and then aiming to eventually buy their home, whether that be a traditional home or a condo, something along those lines they wanted to own. That's not always the case anymore. A lot of people actually see a lot of advantages to remaining a renter. So if that person's going to remain a renter for decades, it would be great to have historical data on how they paid along the way to help the next person make that decision.
100%. When we, as PMs, when we are talking to a new applicant, and they might be on the bubble with some things, and you're like, well, let me do a reference back to your other PM. If they were not a great tenant, it's just going to be when you do a reference on an applicant for a job, it's like, well, if they weren't a good employee, it's like, yep, here's their dates and here's their role and maybe salary. And I say, yep, these are the dates. Oh, yep, always paid on time. They'll be a great tenant for you, Joe. You're going to love them. And, but if we have this empirical data that shows really what the reality is, then we don't need to do those kind of reference checks back to other PMs, which also is timely, or it takes time, it's costly, all that kind of stuff too. Then you might be thinking, well, but if everybody's reporting positive, what's that going to mean for me? Because then it's only sunshine and rainbows, right? And you could kind of impute when there are holes in that, what that means. If there's, January, February, March, April, we're all good. And all of a sudden May and so forth, there's all these holes and then it catches back up. You could kind of impute that means that they probably weren't on time.
Yeah. But that's where digging in beyond the credit score matters, mm-hmm. right? Mm-hmm. That's the actual credit report. That's that trade line that you're referring to that actually shows the payment history.
Yep.
Yeah, a lot of value to bring in there. Well, I mean, I really, really love the idea of, again, zooming out, looking at the industry as a whole, the future, where we're headed, because I think that's what we're really called to do when we work for technology companies, right? Like, how do we continue to build our industry to a positive direction? Yes, we want good things for our residents. We also want to make sure we're protecting our companies, our PMs as we go. And I like when you talked about doing those references to the prior property management company and the type of responses you'll get. It is very timely. And I also think there's a lot of risk in there for the PM, but also the renter. You are allowing a conversation to potentially dictate whether or not somebody has housing or not.
Yeah.
Right. I just think that's probably the wrong way to go. I think we'd all love to just use data to help make that decision. That just seems like the obvious answer.
Yeah. Otherwise, it becomes completely subjective to that person, and they may not say the words that are negative, but they could imply things. And maybe we should just, when we talk about fair housing, maybe just be a bit more empirical on what we're looking at. That way, we can just make yes or no decisions. I know a lot of screening companies shave off a lot of kind of personal type of things, or even names, so it just becomes about the data to really make sure they stay on the side of fair housing. And this certainly would be another input to that. Yeah,
absolutely. So let's talk a little bit about what it looks like to use a product like this. And we don't have to go into great detail, but give us some high level, somebody that's not doing this right now as a PM. What does it look like to start? Is this a complicated process? It seems like it could be when you think about reporting data, accurate, complete data, like you said, to the credit bureaus. What does it look like to implement a solution like this?
Well, for us, it's incredibly seamless, and honestly, it's a lot because of what Rent Manager has done within your all's platform and how you expose the API and the like. It's made it incredibly seamless. So for a Rent Manager property manager, it's just as simple as going in there and clicking a button to enable the integration with us. Our sales process is very quick, maybe a 30-minute conversation to kind of take you through what it is. We have a couple different ways of doing that, from, we talked about complete to positive only, a couple other things that might fit for your portfolio based on state, local regulations too. Those things could play in. And we just kind of talk through that. It's about 30 minutes. You push the button, we get you integrated. We can have you up and running within a week, essentially. And the data then thereafter, it just flows automatically. Our system will pull it from Rent Manager at a given date. You ask, you tell us what date you want that to be, whether it's the 20th or the 18th or whatever. We pull that in. We have a great dashboard that you can look at where you can see have complete transparency back of what was reported, all the information that you want to see about your residents. Maybe you need to make a tweak on one, like there could be certain payment kind of systems that they have in place where it's not really recorded in Rent Manager directly, and you just like, okay, no, they're not delinquent, they're in good shape. You can make those edits, honestly, maybe 5 minutes a month, and then it submits to the credit bureaus, and you can decide if you want to submit to one or all four. And I said four because we've got Equifax, TransUnion, Experian, and now Innovis as well, which I gotta say, Innovis is a Columbus brand too, so I love that.
Yeah, no, that's great. And really making things simple is really what people want to hear, right? Yeah. With this idea of it's not going to add more work. You had mentioned earlier about this idea of certain regulations kind of forcing this upon certain PMs in certain areas that could come at a cost, right? So if it's going to cost money, they definitely don't want it to cost more time because they want it to be simple. And they want to, for the most part, remove themselves from some of that data portion because of the risk that is involved in reporting wrong information, right? They want it to be complete and accurate. And it sounds like it's very easy to make any accommodations along the way through your software. Yeah. And you said 5 minutes a month. Most of us have 5 minutes.
Yeah. And if that, a lot of our customers, more than half of them have it on autopilot because they know that their data in their property management system, Rent Manager, for instance, they know their ledger is good. They know that how, the cash apply stuff, everything, they have everything set up correctly. And if it's in Rent Manager, it is correct. The other side of that people say is like, well, what if what if residents have questions, or what if there's disputes, or what if there are bankruptcies or anything like that? we at CredHub handle all of that. So there's not an additional load to the property manager at all. So, we're trying to take work away from them and, give them more time to do what they do best, which is to lease space, lease units. The other part of that we've also released here is kind of an AI component. We had a long conversation about AI, but an AI component where it will conversate back to the resident about, hey, Joe, you were delinquent here. We reported at the credit bureau. And there's typically a question back of, well, why was that? And then there's a whole conversation of, but I paid this. And all that kind of friction that happens from the property manager having to go look it up, give those answers, all that kind of stuff. We've removed that with our AI bot to just answer those back and forth through SMS or email.
Now, that's great. A really good, specific, and niche way to use AI, like we talked about earlier, really has to be that focused at this point, AI, to be effective. And I'm glad you talked about the disputes, because that is something I have heard people be concerned about is, well, what happens when something is reported negatively? Now I've got to put up with this. It's actually something I've learned through the process of getting to know some of the options out there like CredHub, is there's a whole standard out there for how companies like yours has to handle disputes. Like, this is not something that isn't already decided. There's already a process in place. There's already a mechanism for consumers to be able to report concerns and for them to be handled, which was great to learn, right? That it won't fall to the PM.
Right.
That if there are questions, they can easily move those questions over to CredHub. Your team is well equipped and ready to take on those questions.
Absolutely. And, occasionally things happen. There's mistakes made, sometimes that happens, and we have the mechanism in place to fix that consumer's report. It's very easy. It gets updated, after we've updated it, typically gets updated on their credit report within 24 to 48 hours, maybe 72 in a long kind of situation, but it's pretty fast. When that consumer sees something on their credit report and they hit dispute, that messaging is coming to us, CredHub. And so we're trying to be that first line of defense so that, you've added this product, you added this great feature to your lease, and it's a great benefit to your residents. We don't want to add more work because of that. And so, we certainly do it in a really seamless way. We help you with, your leasing side of it to get it added into your lease. There's some verbiage you've got to put in there. We'll help you. We put all that in there for you. And then, there is an opportunity to make some money on this too as a PM to kind of upcharge from the service too, and most do. Or, what's more of the trend is they've built a resident benefit package and, maybe they can bolster that a little bit more.
Yeah, no, that's great. Well, Tony, if people want to learn more about CredHub, how should they reach out to you and your team?
Well, certainly going to our website, credhub.com. As a rent manager customer, right there within the app, you can just click on the integrations and search for CredHub, and we're right there, and you hit the contact sales button, and I'll send a message directly to us, and we'll get talking with you soon.
Yeah, that's wonderful. Well, I really appreciate the time today to learn more about this. This is a really important topic. I do think we'll see more regulation. I think we'll see more consumer education on this. This is not going away anytime soon. Creditworthiness is a big part of how our society functions and how we assign different rates and values to things. So it's definitely very important for our residents to get in contact with the ability to have their rent reported. So definitely want to thank you for your time today.
Yeah, thanks for having me, Joe. It's been a blast.
Yeah, thanks a lot. And thanks to our audience for listening in to another great episode. And until next time, keep going beyond rent.
Thanks for joining us for this episode of Beyond Rent. If you enjoyed this podcast, spread the word on social media and with your peers in the industry. To be notified when more episodes are released, subscribe using your favorite podcast player. Beyond Rent is brought to you by Rent Manager Property Management Software. Learn more about Rent Manager's industry-leading software solutions at rentmanager.com. Until next time, keep going beyond rent.